and welcome to the ET Money Show. I'm Shrishti Sharma and this show is your one-stop destination for all your personal finance queries. And today we have lined up a power-packed show for you, and here's what you should expect in the next 60 minutes. First up, we'll be joined by Mr. Tarun Birani, who is the founder and CEO at TBNG Capital Advisers, to discuss the strategies to review your portfolio and investment as the year winds up. And next, we'll tell you if it makes sense to cash in on the year-end, the discounts that are being offered by the car companies, and is this the right time to book your dream car, or maybe next year. We'll also throw the light on the launches that are lined up for 2023, as we are being joined by Mr. Kranti Sambhav in this particular segment, who is the editor and lead author at Times Drive. And in the last segment of the show, we'll be joined by Mr. Amit Kukreja, who is the founder and advisory on board for Mr. Amit Kukreja Advisory, to discuss how you can manage your finances and investment if you are one of those who's getting married this wedding season. We will help you plan your emergency fund and tell you how you can start your investments jointly post-marriage. And we'll also throw upon the counter to get your portfolio strategy being checked by the experts. So for giving you a heads up, do send your portfolio queries on your WhatsApp number, that is 865-797-4571, or you can also email your queries onto themoneyshow@etnow.tv. But before we begin our show, let's get you the top headlines of the hour. Nifty snaps three-day losing streak, ending with the gains led by Infosys, Reliance as well as TCS to settle above 18,200. New age tech stocks stumble, with Nykaa losing almost 5%. Brent crude sits below $85 a barrel as reports suggest OPEC could increase output, then recovers marginally to trade around $87 a barrel. Panel of state finance ministers likely to recommend uniform GST of 28% on online gaming for both games of Skills and Chance. Stay tuned for the big update later in the evening. Australian Parliament clears free trade agreement with India. ET Now will decode what it means for Indian businesses this evening in rush hour. So on to the first segment of the ET Money Show today. We'll discuss about whether or not is this a right time to review your portfolio, because markets are inching towards new highs, but the broader markets, particularly the mid and the small caps, have actually underperformed. And since 2023, it's almost around the corner. Perhaps it's the time that you review your portfolio. But the big question is, what should be your strategy and how should you go about it if you want to make fresh investments? And to discuss all this and much more, we are being joined by Mr. Tarun Birani, who is the founder and CEO at TBNG Capital Advisers. A very good evening, Tarun, and thank you so much for joining us today on ET Now. So 2023 is actually around the corner. What we want to know is that, is this a right time to actually review your portfolio? Because if we see in the markets, what happens is that some traders tend to become long-term investors if the stock really don't perform really that well. And I'm assuming that a similar kind of a story builds up in mutual funds and debt, although they are very much less volatile in comparison to the direct equities. But as we end 2022, do you think is the right time to review your portfolio, and what should be one's strategy doing that?
So good evening. I understand the point you mentioned about, is this December or start of the year the right time? I don't think that is the right approach to look at rebalancing. It should not be like close of the year or start of the year one should look at. Yes, but in terms of building up a right habit and a behavior, that could be one approach one investor can take. So let us first understand what is rebalancing all about. Rebalancing is the act of adjusting the portfolio asset allocation based on the investor original allocation, based on the risk and the reward profile. Okay. So now there are a lot of types of rebalancing one can do. One is a calendar rebalancing, and which you just mentioned that a periodic basis, pick up a time period and based on that rebalance your portfolio, which is very easy to do, but it is not responsive to the market changes. Another way of doing rebalancing is a constant mix strategy. Based on constant mix strategy, you define the various components of asset classes. You go deep down into, let's say, emerging market equity, global equity, developed market equities, and based on that you make sure that your equity allocation or the debt allocation or a gold allocation is maintained at that level. So there are various way to do rebalancing, but I feel one should do rebalancing based on the specific objective they have. If it is a long-term buy and hold portfolio, I think a calendar-oriented rebalancing is a good strategy. But if it is a very short-term oriented portfolio, then maybe a tactical rebalancing is something one should look at.
Okay, but Tarun, if somebody wants to start afresh, because especially in 2022, we have seen good inflows coming in, especially in the equity markets through the route of SIP, so that more and more people are getting attracted towards equities specifically, and even mutual funds for same. So going forward in 2023, hoping that this trend continues, and if somebody wants to start afresh, what should be the strategy and what should be the allocation looking like? I know that a lot depends on the goals that you have in mind and how should you, what kind of a return expectations that you have. But according to you, what would be the basic allocation in terms of portfolio?
So let's look at it from two angles. One is the macroeconomic environment where we are in right now. So if you look at last decade or last 5 to 7 years, we were in a period where the interest rates were going down, right? We were in a actually in an environment where there was less inflationary pressure. But now we are coming into a new environment where inflation is and the interest rates have firmed up. And you can see last 6 months to 9 months, we have seen almost 200 to 300 basis point changes in the interest rate across the globe, various markets. So this is not a great environment from an equity investment if you ask me to aggressively start buying equity. But yes, I completely agree that a market like India, and if somebody is trying to build up an India focused portfolio from a long term perspective, India continues to look as a very, very great story to invest in currently. So from that perspective, I feel deployment is something one should look at, and I would recommend a more staggered strategy, and the deployment of funds should be done more based on the valuation of the markets. So one can adopt some easy valuation matrix to put in aggressive money and let's say defensive money into the markets. So all in all, my suggestion would be, if somebody is looking start afresh in the market, they should deploy in a more staggered manner.
Okay, a staggered manner when it comes to investing in equities is something that Tarun is suggesting. But Tarun, what's your take coming in on the debt side of investments? Because for 2022, the rates have been inched up quite significantly, and going forward as well, the expectation is on the higher side, that globally and also in India, we can see the rates going higher. So what will be your suggestion if somebody is want to get into the debt side of investment?
Great. So I feel debt should be used particularly more from a capital protection point of view. And from that point of view, I think we are in one of the best environment to build up a long-term debt portfolio. So we are seeing that almost a 3 to 5 year debt is available at a very attractive rate compared to what it used to be a year before. But going forward, yes, there are still chances that we could see 1 or 2 more hikes coming in based on the environment, how it plays out. So my suggestion would be long-term debt should not be looked at, but maybe at least a 3 to 5 year government securities or a corporate bond papers, high quality corporate bond paper is something looking as a very attractive sweet spot to me right now. And where one can look at booking into target maturity fund or booking into good long-term fixed deposits. But looking at the tax benefit, maybe a debt mutual fund structure could be more attractive.
Okay, but Tarun, you did touch upon the time when an investor gets to know whether it is an appropriate time to go for rebalancing. Just wanted to refresh that for our viewers, that what exactly are the factors that you should be looking out for when it comes to rebalancing, and what all things you need to consider on that front.
So when one look at rebalancing, there are various factors one can look at. One important factor is from a risk profiling or a risk tolerance point of view. Let's say you started with an aggressive investor into equity, wherein your portfolio allocation is 70% equity and 30% debt. And now with the change of the market, you this has moved, the 70 has moved to 85% or 95% equity. So this is time to again get back to that 70% level from a rebalancing point of view. Apart from that, one can look at various component in the individual portfolio. So let's say I want to maintain a 40% large cap oriented, 30% mid cap portfolio and 20% small cap portfolio. If you see that mix is changing in the portfolio, that is also one good way to rebalance your portfolio with that actual levels. But again, there are a lot of positives and negatives of rebalancing strategy. One very big positive is it aligns you with your risk tolerance and used with a certain amount of returns. It maintains that predetermined asset allocation set by the investment plan, and I feel this is extremely important because it will keep you aligned with your long term investment plan. It will make you very disciplined and unemotional about your investing and very dispassionate investing. And again, it change with the investor financial needs and goal. So I feel rebalancing helps in building a more long term durable portfolio, but it has some disadvantage because it builds in some transaction cost. If you sell something, there could be taxation, and again there are some times wherein some may miss a trend. Let's say Facebook has stock has gone up, let's say 200 times in last 5 years, and let's say 3 years later, based on the rebalancing call, you would have actually sold that stock in some part, but it's still growing, right? So again, that may again lead you to miss out some trends. So one need to be careful how you want to approach rebalancing.
Okay, but as you did touch upon Facebook as a stock, so a lot of our investors are keen to know whether is this a right time to go for international exposure. What's your take coming in on that?
So if you look at from a market perspective, last 1 year, we have seen the international markets have gone and corrected significantly. And at the same time, you are seeing the Indian markets have been flat to positive in the same period. So definitely, I feel if one is convinced that international exposure has to be taken, which I am very convinced that one need to have 10 to 15% at least part of the portfolio in the international stocks or international funds. So this is great time because you are actually getting this available at almost 20 to 30% discount to last year level. But again, here one needs to be careful that since we are moving into a high interest rate or an inflationary environment, which these developed market has never seen. So this period could be much more longer, or it could be a tough period. So my suggestion would be the investment should be much more staggered, and you should deploy your money with a much larger time horizon compared to what it used to be before.
Okay, and Tarun, last question is to you, because post COVID, the bull run that we saw happening across all the age groups, those who entered into the equity markets happen to have great returns. But now, when it comes to not being so aggressive when it comes to the equity markets investing, like you were suggesting our viewers, what age gap should be most aggressive looking in terms of equity investments? Because post COVID, we have seen a lot of Robinhood investors also getting into the marketplace. What's the view coming in on that now?
So I strongly feel age is not at all a big factor in deciding the risk profile. There are a lot of factors which plays out while deciding the risk profile. I have seen a lot of young investors in the age bracket of 25, 30, 35 are more defensive in their portfolio approach, because again, the risk tolerance level is based on your past investing experience, what you have seen as a child growing up, what you think about your future or the career. So let's say if somebody will say that, let's say for example, I don't see a good career growth for myself, or I have a job loss. In that scenario, I will not be very aggressive risk portfolio approach, right? So again, it depends solely on the individual investor risk tolerance level. Definitely a young age person has a much more time to retire, so that gives him much more bandwidth to invest into long term. But it necessarily doesn't mean that a young investor should start going aggressive. They need to do their suitability analysis, do their short term, medium term, and long term goals requirement, and based on that they need to build up a portfolio investment strategy.
Okay, we'll let you go on that, Tarun. Thank you so much for joining us today on ET Now. It was a pleasure having you on the channel.